Hello, and welcome to the latest economic and industry update, once again brought to you by Greenbrier's marketing team. I'm Mallory Moran, and I'm joined by Jay Carter. We're going to start today with a brief overview of how the U.S. economy fared overall in 2022. Believe it or not, the U.S. economy ended the year on a solid footing, despite record-setting inflation and recession worries. Remember, gross domestic product, known broadly as GDP, measures how many goods and services a country produces, making it a good snapshot of an economy's health. In 22, the US GDP increased in the fourth quarter at a rate of 2.7% and increased 2.1% overall. Jay, will you please walk us through what contributed to these positive figures?
Absolutely, Mallory, and I'm glad to be here once again to provide an economic update for everyone. So, the GDP figures reflect increases in private inventory investment, government spending, and consumer spending, particularly for automobiles and healthcare, with decreases in residential fixed investment. Building permits were down roughly 30% in December from a year ago, and housing starts were down 22%. Going forward, US GDP is projected to grow by 0.7% in 2023 and 1.1% in 2024.
Thanks, Jay. It's important to remember that the past 2 years saw unprecedented consumer demand and government stimuli, which caused significant commodity demands and a lot of the supply chain hurdles. The economy is still working to normalize. Now, inflation continues to be top of mind, and it has trended downward from its high in June. Jay, how was the January headline inflation?
So, Mallory, headline inflation is still higher than we or the Federal Reserve would like. The good news is that January's inflation was lower at 6.4%. The bad news, however, is that this was only marginally better than what was reported in December. Housing shelter prices were the largest inflation contributor.
Jay, you just touched on the Federal Reserve, known as the Fed, and I'd like to hear what you think they will do regarding interest rates during their next meeting. It seems they've shifted to decelerate interest rate hikes.
Correct. In December, the Fed voted to raise interest rates by 25 basis points. Currently, interest rates are within a range of 4.5 to 4.75%. The Fed has shifted to lower rate increases because it expects U.S. economic activity to be flat in 2023 and doesn't want to prematurely loosen monetary policy.
The Fed isn't only responsible for fighting inflation, another of its goals is to protect and encourage full employment. Jay, how was the January jobs report? We've been hearing a lot about layoffs.
Sure, the January jobs report was very strong. The U.S. added 500,000 jobs and reported a 3.4% unemployment rate. While there have been sizable layoffs in the tech and supporting industries, we've also seen an increase in hiring for services. The employment numbers are both good and bad news as they will support GDP but can also lead to higher inflation.
Thanks, Jay. I know we'll be following these macroeconomic trends closely in the coming months. Now I'd like to transition from the big macroeconomy to the rail industry specifically. As we've said before, railcar orders and deliveries are very cyclical, lots of troughs and peaks. Recently the industry reported fourth quarter railcar orders, deliveries, and backlog for this past year. Over 12,000 railcars were delivered in the fourth quarter, up about 1,400 units from the third quarter. Orders fell below 12,000 railcars, which was down about 14,000. However, that figure is a bit misleading because of the large multi-year agreement that was announced back in the third quarter. Now, the industry backlog shrank just a little to just shy of 60,000 railcars. Jay, help us put these industry numbers into context. How are railcar loadings and velocity?
It's been a tough start to the year for loadings. North American rail volumes overall were down about 1% quarter to date. However, Canadian loadings are up over 6% as the Canadian railroads seem to be outperforming the U.S. railroads in traffic growth as well as service performance. 5 of the 11 major traffic categories posted year-over-year decreases, with the largest decrease coming from intermodal at -4%. Now, network velocity improved slightly in the fourth quarter of last year and could signal that there is a start to an improvement in this trend in 2023. Shippers do remain skeptical, though, as the number of rail cars online remains elevated. We'll have to wait and see if this improvement is sustainable and sustained.
The railcar builder backlogs are very robust and vary between railcar types, but it's important to monitor how many railcars are in storage and are being scrapped, which will affect those backlog numbers. Over the last few months, we've seen slight upticks in stored railcars. Jay, what are you currently seeing in regards to storage and scrap rates?
The total number of rail cars in storage rose to over 300,000 units, which represents nearly 19% of the North American fleet. We saw increased storage from seasonal grain hoppers following the harvest and an increase in coal car storage following a milder winter. The fleet expanded in January by about 1,300 units. Railcar retirements still remain healthy with about 3,500 units scrapped. Now, I expect railcar scrapped will be roughly equivalent to deliveries this year.
FTR Associates forecasts that about 44,000 rail cars will be delivered next year, with freight cars, not tank cars, continuing to dominate the delivery mix. Overall, the rail industry has continued opportunities for growth. Overall, any final thoughts, Jay?
Yes, Mallory, the U.S. economy is in the process of recovering from unsustainable fiscal and monetary stimulus, right? We know that we spoke about that several times in the past. With that in mind, expect balanced or flat economic growth this year, and a smoother landing, smoother than expected.
That's great news. Glad to hear that. Thanks, Jay. And thank you for joining us. We hope you'll find this video valuable. Be sure to check out next quarter's edition.